There's a COO, Eva Ados. And Eva, that sounds ominous. When I read it, it sounds, it's got that feeling like, okay, I can see the dark clouds coming. If that's the case, what changes are you anticipating for the economy?
We think the worst is behind us. We think we'll continue to see continuous announcements that inflation is coming down, especially as housing will start being reflected into the CPI. Housing starts being reflected into the CPI because housing lags by about 6 to 12 months. So real housing data we've seen based on the Case-Shiller index that show that housing is coming down significantly. Mortgage rates are now at 7%. And so that will start being reflected into the CPI announcements. And that will be good news for the markets. And I think although I do believe that Q3 will be choppier than Q2, I do not see big deviations from the highs and lows we've seen so far.
All right. And by the way, I think it was the San Francisco Fed put out a great piece this week on housing coming down. To your point, they're always behind, but they acknowledge that it will happen, particularly going into next year. You do, for investors, though, you do point out that for the stock market, concentration. You talked about concentration risk being highest ever. Investors obviously understand the notion of diversification is something that's pounded into our heads from day one. But they've also been told you got to ride the winners, right? You can't sell the winners. So this makes this something of a difficult dilemma, doesn't it?
Not really. So the rally here today, to your point, has been driven by 6 to 10 stocks, really. It's the mega caps. In fact, the Russell 1000 growth, 50% of its return is because of 3 stocks, and 75% of its return is because of 6 stocks. And now and we think that that's going to change. In fact, month to date, what we've seen is that the Russell 1000 growth is down 2.5%, whereas the large cap, the mega caps are down between 5 to 10, and NVIDIA is down 5% for the day. So I think there's going to be a rotation here. If you're really, really heavy on mega caps, you might need to rethink about it going forward.
All right, and right now, I saw where you were saying investors should avoid long-term bonds, commercial real estate, regional banks, and highly speculative stocks with long-term horizons. So the first 3 we kind of know, right? There have been headline stories about those things, but the notion of these long-term stocks with these horizons, people hear stories, right? Like we're in the 4th industrial revolution. This is the kind of things you invest in entrepreneurs, so you know this better than anyone else. And so we always wish, golly, I wish I owned that stock when it first came out at $5 or $10, and now it's $1,000 a share. So how do you successfully navigate that, being in these things that inevitably are going to be challenged, but also being able to have these grand slams?
So it's a stock pickers market. We saw today Upstart, Roblox, yesterday Datadog. They're down between 20 to 35%. These are significant declines. So we're seeing speculative stocks, some of them not being able to meet expectations. So there's high growth that has been building into their prices, and they're not able to deliver that. So that's one piece. Then you have the regional banks, which is another concern. Moody's put a spotlight again on them recently. And I think the Silicon Valley Bank story is not over. We're seeing more and more examples of these banks not being able to increase their margins. In fact, their margins are decreasing, their spreads are decreasing because they have to pay more to keep the deposits in. So that's another area to avoid.
All right. Hey, thank you so much, Eva. Always appreciate it. Thanks for the guidance.